to this episode of the EFRAG podcast series outlining the EFRAG discussion paper, Accounting for Crypto Assets, Liabilities, Holder and Issuer Perspective. As mentioned in the previous episodes, this series provides insights on issuer accounting. This podcast will focus on crypto asset valuation. To brief us on this topic, I have with me today Isabel Batista, Senior Technical Manager at EFRAG and co-author of the EFRAG's discussion paper, and Heiko Petri, Senior Auditor at KPMG Switzerland and member of the Crypto Valley Association Working Group, focusing on tax accounting and structuring. Before entering the depth of this episode's topic, crypto assets valuation, Heiko, you may want to introduce yourself and tell us more about your work.
Yes, thank you very much, Cecilia. I've been dealing with this topic for a couple of years now as part of my research at the University of St. Gallen, where I wrote my thesis about cryptocurrencies and blockchain technology from a Swiss accounting, taxation and auditing perspective, which also comprises IFRS. And today I'm happy to have the opportunity to share my thoughts about the valuation of crypto assets under IFRS in the light of the EFRAG discussion paper.
Okay, so thank you, Heiko, for introducing yourself. So we'll start with the questions. My first question to you is, well, the question itself of how to value crypto assets is one of the most complex and challenging aspects of crypto assets, crypto liabilities, with different valuation approaches being discussed. And the EFRAG discussion paper discusses some of these valuation methods. Could you share your thoughts and views on which valuation approaches could be more appropriate when applying IFRS?
Yes. When it comes to crypto assets, there are assets that show a new characteristic by having no intrinsic value like Bitcoin, Ether, or Monero. But the market still accredits their value. That is why it is difficult to determine a valuation technique for an asset that has no intrinsic value, but generally just the value of exchange. In the discussion paper, there are different possible solutions presented. The first one is the cost of production valuation. The rationale behind it is that no one would pay more than the cost of something with equal desirability or utility. The problem is that the utility differs between users depending on their specific usage. You also have to consider the profit margin. If everyone was able to produce the good by oneself, there would be no demand. The supply again is stimulated by the profit aspect, but on the other hand, it could be a good indicator, especially for crypto assets that are based on a blockchain which uses a proof of work consensus algorithm, because the miners have to invest in hardware and energy and so on. And the more they invest, the more computing capacities they have, since it is a brute force competition. With higher prices per unit, miners have an incentive to invest more in order to boost their chances. So it becomes an arms race until the costs exceed the expected earnings. But you should consider that the price of energy differs significantly around the world. Moreover, the cost approach hardly works for other consensus algorithms, like, for example, proof of stake. And it also doesn't take into account transaction fees. You also have to consider that the cost does not necessarily equal value, because often the demand for crypto assets exceeds the supply. A more market-driven approach would be the equation of exchange, which is usually based on the discounted cash flows method, which means that the expected future cash flows of certain assets are discounted to present value. Cryptocurrencies like Bitcoin don't generate continuous cash flows like an ordinary share or a bond, but they have an economic utility because, considering the market price, the holder can expect someone else to pay in exchange for the cryptocurrency, which means that the valuation is based on what you will or expect to receive in the future. An even more market-driven approach would be the network value of transaction ratio. This approach shows many similarities to the price-earnings ratio, but many cryptocurrency assets don't generate periodic cash flows. That's the reason why the value is determined by the relation between the crypto asset's network value in the numerator, which is similar to the respective cryptocurrency's market capitalization, and the daily transaction volume in the denominator. The latter serves as a proxy for earnings and represents the value flowing through the network on a given day. The current downside for this method is the lack of historical data and the difficult identification of meaningful comparators. Furthermore, it would be measured in fiat currency, whereas the valuation of cryptocurrencies in another renowned cryptocurrency might make more sense. Generally, you should still keep in mind that the value of crypto assets without an intrinsic value derives from the demand reflected in the market price. It can be questionable whether another valuation method is even necessary. What better valuation can be achieved than the price in an active market? Without demand, these cryptocurrencies don't have value, since even the utility of some utility token, like Ether, besides trading, can only be exploited when a demand exists. For smart contracts to be considered in the blockchain, you have to pay the miners, who will generally only accept the payment if they receive a medium of exchange that has market value. Other tokens, like security token, for example, raise a claim against the counterparty. Those possess an intrinsic value, representing, for example, a precious metal or being like a voucher linked to a certain performance obligation of a counterparty. If a token entitles you to a car wash or a parking slot when it is sent from public key address A to public key address B, it is like a tokenized old world situation. Such a token not only has a market value, but also a value in use, being the opportunity cost, for example, of getting your car wash somewhere else.
Okay, well, thank you very much, Heike. That's really interesting. You gave some really good insights around the demand and the supply and the active market. I think the active market is an important question here, which actually leads us nicely to question 2. So determining whether this active market, as defined under IFRS 13, which is the fair value measurement standard in IFRS, whether that active market exists for crypto assets is another challenging area, at least for a lot of crypto assets. Based on your research, what are your views and thoughts on whether an active market exists and whether you believe this to be a challenging area and why?
It is definitely a challenging topic. IFRS 13 defines an active market as one in which transactions for the asset or liability take place with sufficient frequency and volume to provide pricing information on an ongoing basis, but no thresholds are defined. Referring to the fair value hierarchy of IFRS 13, there's no discrete or binary threshold drawn to refer to for which a market is deemed active. If you conclude that the market for a certain crypto asset is not active, for example, due to relatively low transaction volumes or significant bid-ask spreads, then the application of the lower level 2 of the hierarchy, the observable inputs, is difficult to apply. For those crypto assets without an intrinsic value, the value comes from serving as a medium of exchange and or store of value, but without sufficient demand, hence an inactive market, there's also no observable inputs. Level 2 of the fair value hierarchy may be applicable for tokens that raise a claim against the counterparty. The same applies to level 3 of the hierarchy. Even when an active market exists, it is not straightforward which quote, respectively, market to choose, because for crypto assets, there are numerous marketplaces that usually allow trading 24/7 and can have significantly different prices compared to each other, up to a 2-digit % difference, even though the quality of the asset to be exchanged generally doesn't differ, maybe except for tainted token with a complicated past if it's visible in the blockchain. Often that history is not observable at the marketplace and technically prevented by shielded addresses or ring signatures, etc. The preparer of the financial statements also have to determine which market is appropriate to refer to. Is it the market with the highest trading volume or the DICE, digital currency exchange, for which the company usually chooses to trade for? But maybe this market doesn't provide the most advantageous ask price. You should also consider the high intraday volatility, which in turn is adverse to the characteristics of a currency in general, being to serve as a medium of exchange, unit of account, and store of value.
Thank you very much, Heiko. So already a number of things to consider. on valuation. Well, we know that crypto assets and remains in its infancy in terms of the ecosystem. But however, recently there has been a lot of news around crypto assets. So at this stage, do you think there are other areas that need to be considered for crypto assets and crypto liabilities in terms of valuation under IFRS, which may or may not be discussed in the discussion paper, as it's a very fast evolving ecosystem? Probably as we speak, the DP probably needs to be updated.
Yeah, definitely. There are various areas. For example, the cost of production for miners when it comes to the allocation of overhead in order to avoid the capitalization of idle costs. Since you can't determine the number of tokens to be mined in a year with sufficient certainty, it might be more appropriate to use the expected annual production costs and break them down, in the case of Bitcoin, into 10 minutes of production. Other issues are security token of companies that are used by those companies themselves. If they can control or at least significantly influence the quantity of the token in circulation, then they can influence the valuation. Another topic are stablecoins and the value determination with regard to the underlying. Usually conversion costs have to be considered if the token are convertible at all. Moreover, you should also consider the counterparty risks of the entities that hold the underlying. ICOs are another issue. For example, when security tokens are issued that entitle the holder to receive a share of future profits for a certain period. Since there is an uncertainty concerning the flow of future cash flows, it can be complex to determine the current value of the token when issued. Lastly, there's almost no limit of how tokens are designed with regard to their characteristics. Thus, it is difficult, if not impossible, to determine a standard valuation method that is appropriate for all cryptocurrencies.
Thank you. Thank you very much, Heiko. So I'll just say a few words before passing on to Cecile for a final conclusion. So this is essentially an educational podcast. So to constituents and stakeholders, if this is an interesting topic for you, please go to the EFRAG website. Cecile will provide you just details just now. And please respond and provide your views on this exciting and fast-moving topic on crypto assets. There's a valuation chapter, which we just talked about, but there are also other chapters. So please take a look, and we really welcome your views. Thank you.
Right. It is now time to conclude this episode on crypto assets valuation. A very warm thank you to both our speakers today, Isabel Batista, EFRAG Senior Technical Manager, and Heiko Petri, Senior Auditor at KPMG Switzerland. Thank you everyone for listening and following us during this enlightening podcast. Let me remind you, as Isabel just mentioned before, that EFRAG's discussion paper, Accounting for Crypto Assets, Liabilities, Holder and Issuer Perspective, and all related information are available on our website, www.efrag.org, in both the publication and consultation sections. We very much look forward to receive your comments and your views, either on Chapter 5 or on the entire discussion paper by 31 July 2021. Thank you for joining us.